Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Okay, now please come to IAS 37. IAS 37 is called Provisions, Contingent Liabilities and Contingent Assets. So this standard is very important for day-to-day accounting, especially at the end of the year, when the company will have to sit down and check whether all necessary provisions have been provided for, whether all contingent liabilities have been properly disclosed. And this standard also discusses briefly about contingent asset and the disclosure requirement relating to contingent asset. Okay. So one must understand that accountant's role is not just to record the past transaction. Sometimes some transactions we don't know what will be the amount in future. Although we know that there is going to be a liability, but we don't know exactly how much amount we'll have to incur. And therefore, we need to create provisions as per this standard. What if you don't make provision? There is a liability, but the amount is not certain. The timing is not certain. If you don't provide, your profit will be overstated. In balance sheet, liability will not be properly disclosed. So your financial statement is misleading because it does not give you a clear picture of your liabilities. In future, if those liabilities turn out to be a big amount and you have to pay, it will cause a loss in the subsequent year, but by that time the investor would have suffered the loss. So therefore provisions are important. The standard is applicable for accounting of provision, contingent liabilities and contingent asset. But there are some situations or standards where it is not applicable. So first is the scope paragraph. Those resulting from executory contract. Standard is not applicable to executory contract. But there is an exception, except where the executory contract is onerous. This is called exception and then exception to exception. So does it mean that it is applicable to onerous contract? What is executory contract after point number C in your notes? So let us first read the meaning of executory contract. Executory contract means contracts under which neither party has performed any of its obligation or both parties have partially performed their obligation to an equal extent. Okay. What does that mean? A Limited, B Limited. A Limited has placed an order with B Limited to deliver goods. A has neither made payment, B has neither delivered the goods. Can I say it is an executory contract? Yes. None of the parties have performed any part of their obligation. Another example, A has ordered for 100 units, paid for 50 units. B has delivered 50 units. Both the parties have performed their obligation to an equal extent. So this 50-50 paid and delivered. Remaining 50 becomes executory contract. No need to make provision for executory contract unless the contract becomes an Onerous contract. Onerous means, to put it in very simple terms, benefit that you will derive from this contract is less than the cost of meeting the obligation under the contract. So the standard is little conservative on onerous contract. It says you have to make a provision for onerous contract, even though it is executory. But because you can see there is an expected loss, but because there is an expected loss, the standard says you have to make a provision for that. Is it right? This standard is not a. This standard is not applicable with respect to those provisions which are already covered by another standard. The standard is not applicable to financial instruments, including guarantees that are within the scope of IFRS 9. Of course, the standard says when other standards specifically deal with a certain type of provision, contingent liability and contingent asset, go to that standard. Don't come to me. Is it right? I am a general standard. When a specific standard is dealing with a particular type of liability or provision, go there. For example, income tax. Income tax is also a provision only, because it is an estimated liability. Final liability you will know only after the assessment is over. Leases, refer IFRS 16. But in case of leases, it says this standard applies to any lease that becomes onerous. Once it becomes onerous, then it will apply before the commencement date of the lease as defined in IFRS 16. And the standard also applies to short-term leases and leases for which underlying asset is of low value, accounted for in accordance with para 6 of IFRS 16 and that have become onerous. So some type of leases, you can say some type of leases which have become onerous, apply this standard. So normally in case of leases, what is your problem? You have rented this premise. You have committed to use it for 4 years. You have to pay a rental of 5 lakh per annum. But then you found that this premise turned out to be too small for your requirement. So what will you do? You can't stop your business. You will move to another premise, bigger premise. But then this lease will continue. It is non-cancelable. If you cancel, you have to pay the lease rental for balance period. Benefit is zero because you are not going to use it, but you have to pay the lease rental. So that is why it becomes onerous, and once the lease contract becomes onerous, welcome to this standard IAS 37. It is not applicable to provision relating to employee benefit. So provision for gratuity, provision for leave encashment, all those provisions. Welcome to IAS 19. Insurance contract and other contracts. It's not applicable to insurance contract and other contracts which are under the scope of IFRS 17. But other provisions can be covered. If an insurance company has some other provision which is not an insurance contract or not other contract covered by IFRS 17, then insurance company will apply this standard. Contingent consideration of an acquirer in a business combination, IFRS 3. Revenue from contract with customer, IFRS 15. But IFRS 15 contains no specific requirement to address conflict with customers that are or have become onerous. This standard applies to such cases. So in short, what I can observe, whenever the contract becomes onerous, even though that area is covered by other standard, generally this standard will become applicable. This is the meaning of executory contract we have discussed. This standard applies to provision for restructuring. That is a small part of this chapter, provision for restructuring. Company wants to reorganize its business and therefore they may have to make some provision for expenses, including discontinued operation. When a restructuring meets the definition of discontinued operation, additional disclosure will be given as per IFRS 5. So it is restructuring as well as a discontinued operation. The disclosure of this standard will also be applicable, and the disclosure of IFRS 5 will also be applicable for discontinued operations. Now my question is, why provisions are necessary? Why provisions are necessary? Provisions are necessary for a fair presentation of financial statement. Profit and loss will show fair profit. Financial statement will show fair position of liabilities. Investor will understand what are the liabilities this company has, which they will be required to pay in future. Which means in future the cash outflow will be there on settlement of these liabilities. Understanding this, knowing this, he can take a more informed decision. Okay. Now we'll first go through some key definitions used in the standard. Okay. So first is, what do you mean by provision? Provisions are liabilities. When we were students of accounts in 11, 12, BCom, MCom, even foundation, inter, we used to write provision for bad debt. Is it correct to write provision for bad debt after knowing this standard? No. Why? Is it a liability? Is it an obligation to pay? No. So this is a wrong expression. So therefore, henceforth you will write allowance for bad debt. It's a valuation allowance. Your value of your asset has reduced. There is no liability. Value of asset has reduced. So provision for bad debt, provision for discount on debtor are allowances. They are reduction in the value of asset. Okay, tell me whether this is right. Provision for depreciation. Is it a correct expression? Wrong. You have to use either depreciation or accumulated depreciation, because these are not liabilities. Okay. Okay, one more question. Is stipend payable a provision? Stipend payable to an article clerk. Is it a provision? No. Because provisions are liabilities of uncertain timing and uncertain amount. What is uncertain here? Every month end you will get 3,000 rupees, 4,000 rupees, 5,000 rupees, 3, 4, 5. Okay. According to your form, sometimes 1,000, 2,000, 3,000 also. So amount is certain, timing is certain, that this is the date when you have to be paid. It is a different matter, they may not pay. Okay, rent payable to landlord. Is it a provision? No, same reason. Okay, transporter's bill payable. Transporter's amount payable. Provision. No? Okay, now suppose at the end of the year you have not yet received your electricity bill and your factory is huge. So you will have to provide for electricity expense. So will you call it as a provision? Yes? No. It requires. There is no uncertainty about timing or amount. Okay, amount is uncertain, but the standard says check the degree of uncertainty. Is it too uncertain or small uncertainty is there? You have a meter, okay. Every factory or every house I see there is a meter nowadays installed. You can check what is the reading on the last day of the year. You know how much is the rate of electricity. So rate multiplied by unit consumed and plus whatever charges they levy on the bill, you can do an approximate calculation. Variation in your calculation and actual bill will not be too different. So uncertainty of amount is there, but it is not going to be a significant difference. But let us think about provision for warranty. You are selling the goods. Suppose you are selling TV, 3-year warranty. Any manufacturing defect, we are going to replace, repair, rectify. Now here I don't know exactly that how much expenditure we will have to incur to fulfill our warranty obligation. How many customer will come, when they will come, with what problem they will come, that is uncertain, timing is uncertain. So yes, this can be called as a provision. Provision for warranty. Then provision for legal disputes. Court case is going on and then you are not sure how much amount you will have to pay. You will have to pay that you know, but how much amount you don't know. In this case you will have to make a provision. Okay, one last, creditor for goods. He has not sent you the invoice. Till the year end he has not sent the invoice, but you have received the goods. You have consumed it also, or it is lying in your stock. Will you not make a liability provision here? You will create a liability for the goods received. Is it provision or trade payable? Trade payable. So the standard says many times, even in your offices and even in many listed companies, statement of financial position also, they write the word provision for even those expenses where the amount is not uncertain or timing is not uncertain, but it is payable at a future date. Next is, what is a liability? A liability is a present obligation of the enterprise. What is present obligation? Present obligation. This word will be used so many times in this standard, which is defined below also. So what I'll do, first I'll go to present obligation. Present obligation means if based on the evidence available, its existence at the balance sheet date is considered probable. That is more likely than not. What is more likely than not? On a scale of 0 to 100, this is the scale of 0 to 100, probability scale. And this is midpoint, 50. So, in case, if you think probability is more than 50, if you have crossed this 50, it means it is more likely than not. Then it is a provision. So you can write mathematically, probability that the liability exists is more than 50%. Now sometimes we don't know whether the liability exists or not. Court case is going on. I don't know whether I am going to pay or I am not going to pay. Based on your past experience, judgment, experience from other firms in the same industry, check what is the probability that the liability may have to be paid on the reporting date. And if you think that the probability of this liability is greater than 50%, it is more likely than not, and then welcome, you are a present obligation. Arising from past event, we will create provision only for those obligations which will arise from past event. We will not create provision for future events which are yet to happen. If future event may cause a loss to the enterprise, we will test for impairment, but will not make a provision for that. Okay. So future events may be considered, but not under this standard, but for computation of impairment. In example of past event, company sells goods, gives warranty. So selling goods with warranty, past event. Court case is going on for violation of income tax law, GST law, or infringement of trademark, copyright, patent of other entity, past event. In case if you sell the goods and you give an assurance that in case customer doesn't like, he may refund it, past event. If the law of the country says if you pollute the environment, you have to pay penalty, polluted the environment, past event. Okay. And the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefit. So when you will settle this obligation, you will have to transfer some economic resources to the other party, okay, which normally would be payment in cash or bank or cash equivalent, or you may have to settle by giving some other asset, or you may have to give some security, etc. So these are your resources. Your resources will be given to the other party to settle this obligation, settlement of which will result into outflow from enterprise of resources which have economic benefits. So you may have to give your machine to settle the liability. That is also satisfying condition number 3. Now if I merge the two definition and if I ask you prepare a checklist for provision, when is an obligation provision? It should be liability, means there must be present obligation. So first check the probability of the obligation. If the probability is greater than 0.5, then you check whether there is any past event, okay, and the amount and timing is uncertain, and on settlement outflow of economic resources will take place. On settlement of this obligation, outflow of economic resources will take place. Then it is a provision. And when it will be recorded in the books, if it can be reliably measured. So if it can be reliably measured, reliable measurement, then it will be also accounted in the books. Right? So this is like a small 5-step test for checking whether an obligation can be provision as per the standard or not. So creditor is a liability but not a provision, because amount and timing is not either too uncertain or too uncertain. With some reasonable effort it can be calculated. Electricity bill, rent payable, stipend payable, transporters bill payable, and payable for different type of services that we avail normally will not be a provision, because we have a contract. We know this is the amount that I need to pay for this party. Okay. What is a possible obligation? Possible obligation means based on the evidence available, its existence at the reporting date is considered not probable. So we are somewhere here only. Okay. Probability is less than 50%, or you can say less than or equal to 50%. Practically for such items you can't actually have a statistical figure like 50%. It's just a judgment. Okay. If you think there is a court case going on, but we are going to lose, has a less chance, less probability, then it is a possible obligation. If it is a possible obligation, it is not a present obligation. If it is not a present obligation, it is not a provision. So possible obligations will not lead to provision, but possible obligation may lead to contingent liability and may be required to be disclosed. Okay. Now next is, what is an obligating event? Obligating event, something you have done in the past which makes you obliged. Is obligating event is an event that creates an obligation that results in an enterprise having no alternative but to settle that obligation. Is an obligating event. You have given a warranty to the customer that in case if your product has any manufacturing defect, bring it, we will replace it, repair it. That is an obligating event. You are selling the goods. Take this product, use it, don't like it, return it. That is an obligating event. You have, suppose, copied the copyrighted material, like you do. You have copied the video of some good faculty. Then that faculty has filed a case against you. So that becomes an obligating event. That was just an example. I am sure you are a good student. What about provisions and other liabilities? I had asked you 6 or 7 questions. Trade payable, rent payable, transporter's bill payable, stipend payable, provision for warranty, provision for court cases. So what is the difference between provisions and other liabilities? In case of provision, there is an uncertainty about the timing or the amount of future expenditure required in settlement. That is the main difference. There are 2 uncertainties. One is timing. Say for example, you have given warranty. Nowadays many electronic goods, electrical goods comes with 1 year, 2 year, 3 year warranty. Okay. Goods are sold today with 3-year warranty. So I don't know whether the customer will come with some kind of complaint in first year, second year or third year. So timing is uncertain. And then if he comes, how much amount I will require to spend to rectify this problem is also uncertain. Okay. The standard says matching concept. You are recognizing revenue here. So you have to also recognize provision for warranty expense here. Based on whatever goods you have sold, you have to make a provision for warranty also in the same period when you are recognizing the revenue. So it is relating to uncertainty. But trade payable and liability for goods and services that have been received or supplied have been invoiced. Suppose you have not received the invoice, have been formally agreed with the supplier. So that means you can calculate the amount with reasonable assurance, reasonable correct figure, And there is no major uncertainty about timing also. Because when you are buying goods from your supplier, you have fixed terms and conditions. This invoice will be paid after 45 days or 1 month or 2 months from the receipt of material or receipt of service. So where is uncertainty? It may be there, but it is not of that level. Accruals are liabilities to be paid for goods or services that have been received or supplied but have not been paid, invoiced or formally agreed with the supplier, including amount due to employees. For example, amount relating to accrued vacation pay. In any case, amount payable to employees are covered by another standard. Okay. But still, calculation of such item like accrued vacation pay can be done with reasonable certainty. Although it is sometimes necessary to estimate the amount or timing of accrual. I'd asked to electricity bill, which you may not receive, but you have to account for that expense on accrual basis. But the uncertainty is much lower than the provisions. So therefore, we should not call them provisions. Accruals are often reported as part of trade and other payable, whereas provisions are reported separately. When should provision be required? Now my accounting begins. When should you recognize provision? Already we have discussed this checklist. 1, it should be a liability. A liability which represents present obligation. Present obligation means probability of this obligation existing on the reporting date is more than 50%, more likely than not. And that obligation can be legal also or constructive also. The law of the land says you will not pollute the environment. You will not dump your waste material in the river. But the company has done that in the past. So therefore they may be required to either clean the environment or pay the penalty. Or constructive obligation. Constructive obligation is business practice. Okay. Company says in case if you do not like the product, you can return it. I will give you the refund. Many times it may not be officially or formally spoken to the customer. But over a period of time, you are doing that. So customer has an expectation that in case if I don't like it, I can return it. Then it becomes a constructive obligation. Due to past event, and it is probable, that is more than likely 50%, more than 50% probability. Outflow of resources embodying economic benefit will take place and reliable estimate can be made of the amount of obligation. This is like a small checklist for you. Okay. So what are the key terms you will take from here? Present obligation, past event, then outflow of resources, reliable estimate. And one more thing you will note down to call it as a provision, amount and timing. It is a liability and it will be accounted. Now this, even if these 4 points are present, that means now this liability needs to be accounted for, provided in the books, and to call it as a provision, the amount and timing should be uncertain. To call it as a provision, the amount and timing should uncertainty be involved of a higher degree. Uncertainty of higher degree. So we have just made a small summary of this. Obligation can be legal or constructive. Legal obligation can be contractual through explicit or implicit terms, or due to legislation or due to any other operation of the law, and constructive, as I discussed, may be due to past practice. So you can write past practice. Or when you create a certain expectation in the mind of other parties. Okay. Every year if you are paying Diwali bonus and you don't pay Diwali bonus in this year, is it going to work? No. Even though legally you may not be required to pay Diwali bonus because Payment of Bonus Act may not be applicable to you. Okay. But because you pay Diwali bonus every year, it is like a constructive obligation. Now we will check in one example whether this situation warrants provision accounting or not. There is one example. Check, is it there? Problem number 1 only. At the end of the chapter. Next example. Problem 1. A manufacturer gives warranty at the time of sale to purchaser of its product. Under the terms of the contract for sale, the manufacturer undertakes to make good by repair or replacement manufacturing defect that become apparent within a specified period from the date of sale. Is provision required? A very typical basic question on this topic. So we have to ask 5 questions. Question number 1, whether there is present obligation. Whether there is present obligation? You will assume yes, because you are selling with warranty. So whenever the customer will come, you will have to pay. So you assume yes. Second, is it past event? What is the past event here? What is the obligating event here? Sale of goods and giving warranty to the customer. Will it result into outflow of resources embodying economic benefit? Yes. Because when you do repair, replacement, you have to incur some expenses. Fourth, what is fourth? Reliable estimate can be made. Sometimes it is difficult, but if the question comes in this way, you have to answer yes. We have to make an estimate only. So based on our past experience, based on experience of similar firms, or you can take the technical advice also, you can make some estimate. And whether it involves substantial degree of estimation with regard to amount and timing. Again the answer is yes. So you can just make a checklist, 5 conditions, yes, 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 welcome. You are a provision. Okay. And sit in our balance sheet now. So present obligation as a result of past obligating event. So that is yes. Because there is a contractual obligation, legal obligation is there. Outflow of resource will take place, and more than 50% likely chance is that you may have to incur the expenses. You will assume reliable estimate can be made. Therefore, company should make provision for warranty. Okay, one more we'll try. Second question. A chemical company causes contamination of land. Okay. What is that? Contamination of land. Land pollution. When you dump chemicals, you're actually harming the land. But cleans up only when required to do so under the laws of the country in which it operates. The country in which it operates did not have any legislation requiring cleaning up. Very good. Pollute. Okay, no law. And the entity has been contaminating land in that country for several years. Welcome to India. At 31st 2014, it is virtually certain that, this we'll discuss later also, virtual certain, that a draft law requiring a cleanup of land already contaminated will be enacted shortly after the year end with retrospective effect. Is provision required? Now we will discuss this line after some time, some basic features of provision. But for that timing, when it is virtually certain that a law is likely to be enacted, then the company may have to make provision, because in this example the law will have a retrospective effect. Law will have retrospective effect. Okay. And it is virtually certain. Whether provision is required, 5 questions once again. Is there a present obligation? Yes, virtually certain that law will be enacted and company will be required to clean up the land. Second, is there past event? Oh, several years you have been contaminating the land. Third, outflow of resources. Either you have to clean up the land or you have to pay the penalty. You choose whatever is feasible for you. Okay. Fourth, reliable estimate can be made. And fifth, it will require significant amount of estimation in terms of amount and timing. So the answer is yes. You should make provision. The answer is printed, just read it yourself. Read. So now we'll take a break.